We had a robust day in the stock market as the S&P 500 was up 1.29% based off of a couple of different major news stories. First of all, lawmakers in the United States got together on a border security deal which looks to be preventing a future government shutdown. We then heard some news that President Trump was going to perhaps be a little bit more relaxed around the March 1st deadline between the United States and China to try to get together on a more significant trade deal. So both of those news events help support bullish trading here today. We will focus on a down and out sector in my trade application example here tonight based off of some interesting news where we found a major insider and actually founder of a company buying sizable amounts of company shares. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 12th, 2019. First of all, if you're new, welcome aboard. We're grateful to have you in our audience. Remember, you can go to YouTube and subscribe to our channel there. You can also sign up for our email distribution list in the link provided in the description area. We also are heavy users of Twitter. Make sure you're following me there at Brandon Van Zee. And if you ever see David or I tweeting about these Market Outlook videos, it does help us along if you can click like and retweet to let us know that you want us to continue doing them going forward. We also have a presence on Facebook. You can see the group web address embedded in the logo in front of you, so feel free to join us over there as well. All right, let's go ahead and dive into the charts. As you can see, we do have Chart 4B pulled up here in front of us for those of you that are premium market scholars that want to follow along at home. As you can see, the S&P 500 was up 1.29% today, and that was a pretty solid looking candle, as you can see right there on the chart. Now, of course, that did not change our posture. Our posture has been bullish for the entire year. In fact, as you can see, the background color of these charts will aid you in understanding when the market forecast intermediate line suggests we have a bullish or a bearish posture. Anytime you see that green background color, that means that we have a bullish posture. When we have that dark green like we do right now, it means it's strongly bullish. So really ever since this day back here on the 4th of January, we had a bullish posture, and we've continued to maintain that bullish posture ever since. So it's kind of interesting looking at this 3-month chart here. We have sizable downward price action in the first part of that 3-month period, and then sizable price action to the upside. I bring that up because, you know, as I kind of take the temperature of not only folks that we work with here at Market Scholars, but also just FinTwit or the financial media on Twitter. You know, there's a lot of sense out there that, you know, the market should be pulling back. After all, stock market can't go straight up without some sort of a reversion to the mean type of a move. And traditionally that is the case, but remember, markets typically don't go down as quickly as they did in the fourth quarter of 2018 without a legitimate reversion to the mean back higher then either. So we probably had more of a pullback than we deserved back in 2018, and we might be receiving more of a pull back up than we deserve so far in 2019. And where we stand here currently is basically flat performance. I mean, if you look at where we're standing here currently on the S&P 500, it's almost identically in line with where we were trading exactly 3 months ago. So has there been some fairly significant and wild trading in between? There has, but over a 3-month period, we've largely gone nowhere. So anyway, that's where we stand here with the S&P 500. Same thing can be said for basically all 3 of the additional indices there as well. We continue to have a strongly bullish posture on the Dow Jones, which was up 1.5% today. We have a strongly bullish posture on the NASDAQ, which was up 1.46% today. And we also have a strongly bullish posture on the Russell 2000, which was up 1.27% today. You'll notice that all 4 of these charts are above a rising moving average as well. Notice that the moving average color on this chart setup does change whenever we have that rising sentiment, or I should say the rising price action above that moving average that is also rising. Notice that that moving average can turn yellow and also red under different circumstances. So it's generally viewed as a positive thing when we have both a bullish posture using the market forecast intermediate term line, and then also where we see price action behaving itself rising above a rising moving average as well. Let's go ahead and take a look at our next chart setup now. and this will be chart 4C. And 4C is a chart that we use to kind of get a sense of what's going on with our so-called 3 green arrows philosophy. And 3 green arrows is just kind of a fun way to talk about 3 different technical indicators. The first of the green arrows that we look for is the 30-day moving average. If price is above the 30-day moving average, like we see over here on the S&P 500, notice that arrow right there. That first occurred when price went above that moving average. So we have one arrow that is green locked into place on the moving average. However, our next arrow on the S&P 500 is red. That's the MACD, and we use that to measure momentum of the current particular security, in this case the S&P 500. So we've got a little bit to work on there, and that's a result of that pullback that we had, that mini pullback that we had here about a week and a half or so ago. And remember, since we're so close to that 0 line on the MACD histogram, we could easily revert back to a green arrow here within just a couple of days. We do have a phantom green arrow on the stochastics at this point that is still in effect. So notice that 3 out of our charts have a mix of green and red arrows. We know that very quickly by judging the background color of the chart over the current candle. And notice that it's white right now, and white suggests that we have a mixture of red and green arrows, except for the Russell 2000. Notice that the Russell 2000, we do have something new to report today, which is we do have 3 green arrows once again on the Russell 2000. Notice that the background color of the chart has now turned green here, and the reason for that is going back to that MACD. Notice that the MACD did revert back to this green arrow, so the momentum up was strong enough on the Russell 2000 to kind of push that MACD back to that positive status there. So the small caps continue to be an impressive area so far in 2019. Let's go ahead and take a look at our next chart now. This will be our longer term chart here. This is our 1040 crossover method chart. This is chart 4D for those of you that are premium market scholars following along at home. And the way that we use this, first of all, it's 3 years in length. Remember, all those other charts we've looked at thus far have been 3 months. So this is 3 years in length that we're looking at for each of these 4 charts. And each one of these candles represents 1 week in time as opposed to just 1 day. And what we're largely looking for here are crossovers of the moving averages themselves. And so you can see that we've got some labels above the chart to help you understand what we're looking at. And so let's maybe use the S&P 500 as our example in this case. I'm going to right-click on the chart and go to Maximize Sell, so that way you guys can see it a little bit easier there. Now notice the S&P 500 is now trading above this blue line. This blue line represents the 40-period exponential moving average. For those of you that use daily candles, remember that in a daily sense, it's like a 200-day moving average. So when we use weeklies, since there's 5 trading days in every week, if you take 5 times 40 for this 40-period exponential moving average, that equates to the 200-day moving average. So for those of you that are kind of in that mindset, you can think of this blue line here as the 200-day moving average, although you'll hear us refer to it as the 40-week moving average. Now in this particular case, a lot of people have been notating here recently that the S&P 500 is now trading above its 200-day moving average. And for some folks, that's an important consideration, especially for longer term investors that use the 200-day moving average. It is a slower moving average, so it's certainly not going to work at all times, but generally speaking, longer term investors feel a bit more comfortable if the markets are above those 200-day moving averages. Well, what we're looking at here in this particular chart, and the reason that the background is still pink, even though price action is above these moving averages, is because the background color of the chart is not going to change until we get a crossover of the moving averages themselves. So remember, there will be a lag to that, because all moving averages have a lag based upon the amount of time that they're tracking. And so if price action remains resilient and robust up in this area here, it looks like we may very well get a bullish crossover here at some point in the next few months. Notice that the orange line in this case, which is a 10-week moving average, has now easily curled up and is getting awfully close to actually touching that blue line there. So once that orange line does go up and through that blue line, the background color of our chart will turn green yet again. Now, we recognize that this is a system here, this 1040 crossover system, that is not going to ever call the tops or the bottoms. What we're trying to do is capture the major chunk in the middle. And you will notice that the last time we had a bullish crossover, at least on the S&P 500, was way back here in early 2016. And by the time we had a negative crossover, that occurred right back here in late 2018. So that actually turned out to be a really healthy amount of profits that were available to investors that wanted to kind of follow this philosophy. Obviously, the future is no guarantee, and it's never going to look exactly like the past, but that can at least give you an idea of the resilience of the move that we saw, and also how you can kind of try to stay put a little bit longer as well. Some of you might feel like the market has whipsawed you to death, and every time you get in on a stock, the stock reverses lower, or every time you short a stock, it goes higher. That is chop and slop, and that happens to traders. If that happens to you regularly to the point where you get so frustrated that you feel like there's got to be a better way to kind of ignore some of that chop, some of that noise, then perhaps something like a 1040 crossover method on a weekly candle chart could be useful to you. So we'll keep you posted if we do see a crossover, but right now things are looking fairly promising for one to occur here reasonably soon, assuming that the stock market holds up at around these levels. Let's go ahead and now take a look at our next chart setup, and this one will be chart 4E. And this will be our 12 grid looking at the intermarket analysis. And so these will be kind of non-stock oriented charts that we're looking at here. And as we look at this, you know, the types of things that we're looking for, typically, you know, what sort of trends are being identified, what sort of reversals of trends are worth noting, et cetera, et cetera. Also remember that when you look at the background colors of these charts, they identify whether you have a bullish or a bearish posture using that market forecast intermediate term line. When you see the green, it means bullish. When you see the red, it means bearish. So as we look at this particular setup, you know, one thing that does stand out to me right now is that Treasury yields have been in a bit of a bearish move here recently. Notice that moving average line continues to sink lower. Notice the pink background color there identifying that bearish intermediate term posture. And then, of course, the flip side of that is the chart directly below it, which is the price of U.S. government bonds. And these are the long bonds here tracked using TLT. But that has a bullish posture there. And that's not usually the most beneficial thing for the stock market. There are plenty of occasions when money is searching for some sort of a safe haven if money is nervous about riskier assets like stocks, and oftentimes U.S. government bonds are the beneficiary of that. So that makes this move maybe a little bit more peculiar in that stocks and bonds are doing reasonably well. And it's not just government bonds, I might add. Notice that the junk bonds also have a bullish posture. We have foreign bonds right here with a bullish posture, and you can look at some of those other higher income alternatives to bonds like REITs, MLPs, and preferred stocks also having bullish postures. In fact, we talked about an MLP in my dividend growth investing class here today. So for those of you that are premium market scholars, that recording is now posted, and you're welcome to check out that analysis on that particular master limited partnership in that class. But another thing that we've been kind of looking at here recently is what's been going on with the US dollar. Notice that the US dollar is down below here, and we continue to retain our bullish posture on the US dollar. Remember the last time I was here, I was mentioning how we had broken up and above this mini area right here of resistance. And so you could really kind of go on record stating that we now have a set of higher highs and higher lows. Now, it doesn't guarantee anything about the future, but at least it's a starting point if somebody was looking for a reversal. So here's a low, here's a higher low. Here's a high, here's a higher high. It does look like we are in a little bit of a pullback today. We were down 0.35%, but as long as this move lower doesn't come back all the way down to this area that we achieved on January 30th or below that, then that trend of higher highs and higher lows will remain intact. And remember, when we have a strong dollar environment like this is suggesting here over the last month or so, that can add pressure to things like commodities. And you'll notice that ag commodities has struggled here in recent months. We did get a nice pop today out of ag commodities, but again, remember that the dollar was down today. So from an intermediate perspective, the dollar has been reasonably strong and ag commodities have been reasonably weak. But today, the dollar was down and ag commodities were up. But you can see clearly that that trend for ag commodities is to the downside. Whereas the trends for oil are a little bit different. Notice that we had a little bit of a pop higher on oil today, but I wouldn't necessarily call this a downtrend the way that I call ag commodities a downtrend. This is more of a stabilization that we've seen out of oil prices here recently. And part of the reason for that might be because oil prices were really kicked to the curb late last year, much harder than other asset classes. So, perhaps that's already been baked into the cake as far as how much damage will be done to that particular commodity. Right now, it's doing a pretty good job holding the line. We do have a bearish posture on it, but the fact that we have price above a rising moving average right here leads us to believe that the bulls aren't necessarily just going to roll over this time when it comes to oil prices. Let's go ahead and take a look at our next chart setup, and this will be chart 4F. This is our foreign stock markets chart. All right, so as we look at this chart, there is a kind of a change that's taking shape here. As I've been doing these presentations in the last few weeks, we've kind of gone through a period where the foreign markets were actually performing quite well. In fact, a couple of the presentations, I recall that we had a clean sweep of bullish posture when it came to the foreign stock markets. You can see that that is starting to change, and perhaps that's a direct result of what I mentioned a moment ago with the dollar rising and the dollar having higher highs and higher lows here over the last month. It's probably started to pressure foreign securities on a relative basis, at least compared to the U.S. markets. Remember, when the U.S. dollar is strong, it makes it difficult for foreign investments to look attractive in that type of an environment. And so that's where we kind of stand right now. You'll notice that it's about split here. We've got about half the charts pink and half the charts green at this point. Of the ones that are maybe a little bit more concerning, I would say that India ranks near the top of that list. And the reason I say that is you'll notice that a lot of the other charts do have pink backgrounds, but India is the only one, at least amongst these 12 charts, that has both a pink background and a pink moving average. And remember, that pink moving average signifies that price is below a falling moving average. So it tells us that there is technical damage being done from a price perspective in addition to what the technical indicator of the market forecast is telling us from a posture perspective. So be on the lookout there for India. That's the one where it's not really shaping up all that strongly at the current juncture, and there may be other places that are a little bit more promising out there. Even Russia, which is just to the left of the India chart up here, is holding up a bit better. Notice that Russia remains above a rising moving average right there. Remember that Russia is somewhat attached at the hip to oil prices, since a lot of the Russian stock market from a market cap perspective is dedicated to major oil companies. And so perhaps what I mentioned a moment ago regarding the oil price stabilization has allowed Russia to withstand the pressures of the strong US dollar a little bit more so than other countries out there that are oftentimes importers of oil. Remember that India is a massive country, not only from a population perspective, but also from a land perspective. Yet they don't have a whole lot of oil production there. And you can say the same thing for Japan over here as well. Notice that Japan also has a red background chart there signifying bearish posture. Japan has a huge population, obviously a much smaller land size than India, but nonetheless is similar to India in that it needs to import a lot of its oil resources. So when oil prices go up, that can somewhat negatively impact the profit margins of the companies operating in India and Japan because it's going to hit their kind of input costs into manufacturing and all that kind of stuff. All right, let's go ahead and now take a look at the United States, and that is going to be chart 4G here. All right, and so this is just a quick reminder. These are all 3-month charts, and the chart in the upper left is the S&P 500 itself, and then all the other charts represent the 11 sectors that make up the S&P 500. So again, just reiterating the point, you can see right here, the S&P 500 is basically flat over the last 3 months. It's technically up 0.68%. So it's about as flat as you can get, despite the fact that we had a really nasty pullback in price at the end of last year and a huge rip higher at the beginning of this year. Well, as you can see, the S&P 500 remains with a bullish posture, so it shouldn't be a surprise that most sectors that make up the S&P 500 are also bullish. The only exception at this current time is materials, and I'll tell you what, materials had a really nice day today. Stocks like Dow DuPont did very well today based off of some of that more promising news around U.S.-China trade relations. Well, you can see that XLB was up 2.24% here today. In fact, that might be the largest mover. Yeah, it was. This was the biggest mover from a sector perspective on a one-day basis. Remember, the posture and the pink background is representative of an intermediate time period. So it takes today's one-day move in conjunction with everything else that's happened. And it is true that materials have a bit more work to do here to get to some of these higher levels. You'll notice that materials, despite today's really big move, is still underwater over the 3-month period. So that goes to show you that it is an underperformer on a relative basis versus the S&P 500 there. So just be aware of that. But right now, that's the only kind of blind spot in terms of bullish versus bearish. And even that is looking a bit more promising. I actually kind of like the way that materials is bouncing off of that rising moving average right now, and wouldn't be surprised to see materials give us a bullish posture here sooner rather than later, kind of joining the rest of the crew out there. Let's take a quick peek over here at the internet, and just wanted to quickly remind you that you can watch these videos on our website, on our blog area, by just clicking play right here whenever you pull up this day's market outlook video. Remember, we try to make it nice and easy for you to engage with us on social media as well. You'll notice the little icons down below. If you have a Twitter account, you can click on this and click like. If you have a Facebook account, you can click on this graphic and click thumbs up. We would encourage you to do that if you get value out of these videos. I know we have a large audience, but we never know how valuable these videos are. Obviously, the videos are free. You're watching this for free, and it does take time out of David and I's day to do the videos. So we want to make sure that if we're going to spend the hours that we do, recording them and editing them and sending out the notifications and all that hullabaloo that goes into the production of these videos, that it's worthwhile for you guys. Now, my own barometer that I'm looking for is to see if we can get at least 100 likes on Twitter. We came up a bit shy last time. Only 85 of you clicked like on that last time, so perhaps the excitement around these free videos is not what it once was. And if that's the case, then we can always find other things and other uses or other ways to kind of present this data to our premium scholars directly, as opposed to open it up to the freebies out there on YouTube. So if you do get value, that's the one ask that we have for you. Just go out there and click like on Twitter to let us know, and that way it encourages us to continue these videos going forward. The other thing that I will point out, since I'm over here on this area of our website, is that remember that for those of you that are premium members, go over there to David's class tomorrow. He's teaching his options inventory trading class. And then tomorrow afternoon, I'll be teaching my swing trading class for Strategy Lab at 2 p.m. Eastern Time. So looking forward to joining forces with many of you during those classes, similar to how we joined forces today for my dividend growth investing class and for David's directional options class. Also, while we're over here, I wanted to briefly bring up the sector selector, which remember I create on Friday afternoons, and so this is a couple of days old, but is still fresh enough for us to be relevant. Notice that real estate stayed in the #1 slot week over week. Utilities did go up to the #2 slot, so remember that goes back to what I was mentioning before regarding treasury yields. Oftentimes when you see interest rates and yields going lower, you find that real estate and utilities do better on a relative basis. We did see technology fall, but it remains in the top 3 slot. Now today, I wanted to take a peek at a down and out company, or I shouldn't say a down and out company, but a down and out sector. And the one that I wanted to reference is energy, which has been dead last on the sector selector here recently. Some of you might be wondering, well, if it's dead last, why are you looking at it here in this trading video? And the reason is because we're starting to see a little bit more robust price action. So let me come over here. Let's just pull up kind of a, I don't know, let's pull up a plain market forecast chart. So 5A for those of you that are premium market scholars. And let me kind of give us a little bit more room to see the price action up there on top. I wanted to show you, first of all, with XLE, which tracks the general energy sector from the S&P 500's perspective. Notice that we had that nice little bounce there here in the last couple of days off of that rising moving average for the energy stocks out there. So that has been helpful for those of you that have been a little bit nervous about those. Another thing that I wanted to point out in particular with our trade application here today is if I pull up KMI, that's the stock I wanted to talk about. This is Kinder Morgan. Notice that Kinder Morgan right here is near the top end of its range over the last, in this case, this is a 6-month chart. In fact, let's pull up a 1-year daily chart just to give you a sense of what's been going on over the last year. Well, notice KMI is very close to breaking out to a 1-year high. The 1-year high would have occurred back here in October. Now we compare that to XLE, and notice that XLE, despite the nice bounce that it's had here in the last couple of days, is a country mile away from where its 1-year high is as an entire sector. So one way to kind of think about that is, well, Kinder Morgan obviously has a lot of relative strength compared to the energy sector at large that it belongs to. Another thing that I mentioned in the intro that I found somewhat fascinating about this one in particular is that if you come over here to the trade tab and look at some of the news recently, notice that there's been some stories here about the co-founder of Kinder Morgan, which is Richard Kinder. Some of you are familiar with him, one of the richest men in Texas, if I'm not mistaken. Anyway, he is apparently buying a lot of stock. So there's some different news stories out there floating around about this. But, you know, when you see insider buys, it's not always an automatic buy, and this isn't an automatic buy either. A lot of times you want to investigate further, and you want to see, you know, whether it's been a substantial purchase or not. Remember, the old saying is that, or the old thought process is that insider selling isn't necessarily something that is worth paying attention to because insiders sell for a variety of reasons. A lot of times they're just trying to diversify their investment base. And it's not necessarily because they think the stock is going to go down or anything along those lines. But on the flip side, when an insider buys, they generally buy for one reason, and that one reason is because they think that the stock is going to go up. But in this particular case, it's worth investigating whether the amount that the insider was buying was substantial or not. Now, everybody's going to look at money differently, but I myself do think that $10 million is quite substantial. So he already was a major holder of the company prior to this, and he decided here in the last few weeks to buy $10.3 million worth of his own company's stock at around $18.20. He now owns 235 million shares of that company. So that was a pretty significant amount of money that he put to work. And again, he doesn't know the future any more than you and I do, but of course he is closer to the company than most of us are. And so perhaps he has a feeling that they're in a turnaround mode, or perhaps they are going to have a big project that they're going to be developing in the future, or something along those lines. Well, the point is, you look at the chart, and again, we are near a breakout on a 1-year basis. So what I thought we would do here is set up a kind of a buy limit order, or a buy stop order, I should say, when the stock goes up and through its 1-year high price area, which again occurred back on October 10th. And then after we get into the trade, we will then use kind of an OCO mindset, or a one cancels other order, where we have an upside target price and a downside stop loss. In fact, it's very similar for those of you that watched my presentation a few weeks ago when we were looking at Box. For those of you that watched that one, you might recall that particular trade. Remember, we set that one up the same way. We kind of recognized this sideways trading pattern on Box, so we put in an order to purchase shares once it got over these resistance areas. And then after we purchase the shares, the system automatically puts a one cancels one order. And you can see where we stand with that trade right now. Up here we have, we're very close to achieving our price target on Box. Today was actually quite a nice day for it, up about 3%. So we're getting very close to shutting that trade down at max profit up there. But in case this thing were to fall, you know, we do have that stop order way down here as well. So what I thought we would do is something fairly similar with Kinder Morgan, ticker symbol KMI. And in this particular case, I'm going to wait until we break out through the high of this candle. You know, that's going to attract more trader interest once it starts showing up on the 52-week highs list. It also helps ensure that we've kind of broken through any potential resistance that may have occurred on October 10th when it hit that high. And so I think what we'll do is we'll buy this once it gets up past 1867. Once we do buy it, then I want to launch a one cancels other order. So let me show you here what I was thinking in terms of our calculator. You know, if we get in, let's say we get in at 1870, which gives us kind of a 3-cent buffer above our 1867 previous high. Let's say that we get in at around that area and we put our stop loss down here at our previous low where we found a bit of support here at the end of last year. And that's, let's call it $14.60, a couple of pennies below the low print that it had there on the day after Christmas. So 1870 minus 1460 means that we would have about $4.10 worth of risk in that trade. So we'll just do 100 shares here. So another way to think about that is we would have about $410 at risk in this trade if we were just flat out wrong with this mindset here. Now, in order to maintain a one-for-one risk-reward mentality, what we could also do is take that 4.1 or $4.10 and add it back to our price where we assume we'll be getting in, which is around $18.70. And that means that our upside price target would be about $22.80. Now, some of you are saying, doesn't that seem a bit aggressive for this security? Well, it depends upon your mindset. One thing that I will point out is that if you go out to a 3-year chart rather than a 1-year chart, you'll notice that $22.80 would be approximately right at this area of resistance that was taking place back here in early 2017. So we know that it's been there before. And you can see here as we kind of broaden out this view as well, we've got a bit of a double top up at that area, which might be another reason why we'd want to head for the exits anyway. In addition to that, where we'd be putting our stop loss is down here below where we have a double bottom. So kind of interesting from that perspective as well. So let me go ahead and do this. I'm going to right click on the chart and I'm going to go to buy custom with OCO bracket. That loads up my trade down below. I'm going to click the little paperclip icon to kind of lock all those trades together. And I'm just going to do 100 shares in this case, make it nice and easy here for us, and just use the default view there for the paper money account. Of course, you're going to want a position size however you best feel for your own account. But what we're going to do here in this paper money environment is change the top line where it says limit in green, change that to stop. Stop right there. Now notice that once you change it to stop, it no longer has just one green line, it has two green lines because there's kind of, you know, a couple of different things going on from that perspective. But in this particular case, I am going to change this order up here at the top where it says day. I'm going to change that time in force to good till cancel. In fact, I noticed just now, and I've never used this before, so let me try it. I'm going to click the paperclip right above that, and I'm assuming that will change it to good till cancel for all of them as well. So I'm going to click that there, and then I'm going to choose the day, go to good till cancel, and indeed, that's how the platform is set up there. And that way I don't have to change, because I would have had to change it manually down here for both of those as well. So we want good till cancel orders across the board. Now, in terms of the stop price where we want to get in, remember, that's where we need the stock to go up. And that's where we were wanting to get in when it got to $18.68. Now remember, the high price for the year was $18.67. So by having the system only get us in when it gets to 1868 or above. It's basically saying we need to hit a new 52-week high. And once that occurs, then a order will be shipped off. In this case, this is just going to be a market order, so hopefully it's a nice liquid market at that particular time. You could always use a buy stop limit if you wanted to as well, but in this case, we'll just do the market order. So once the stock gets to 1868, a market order for 100 shares will be shot off to the market and will get filled at around that level. Once that occurs, that's when the one cancels other order starts to kick into place. So this next level down here, the first line in pink, this represents where our upside price target will be. And in this particular case, I'm going to use that number that we generated on the calculator of $22.80 as our upside price target. So then the next line down just says stop, good till cancel, and then the third and final line, we need to actually place the stop level. And in that particular case, we are going to go down to $14.60. And so, basically what's going to happen there is if we're wrong and, we think the stock is going to go up, but instead it goes down, then we're going to be stopped out down at that level. And we're going to end up losing $400 or thereabouts. And if we're right and the stock goes up, then we have the potential to make $400. All right, so that is the order. Let's go ahead and click confirm and send. Review it one last time here. Everything looks fine. Let's go ahead and send that off. All right, well, I want to thank you for joining me here today. Always a pleasure to go to work for you. Remember, if you get value out of these videos, be sure to click like on Twitter. Give us a thumbs up over there on Facebook as well if you want us to continue to do them going forward. But it's largely par for the course of what we've been seeing so far in 2019. Strong market day, which we continue to have bullish postures across the board. So with that, I want to wish you all the best with your trades and your investments. Goodbye for now.